When I started trading gold using ICC, I thought the hard part was learning the pattern. Indication, correction, continuation, 3 steps. Simple enough, right? But I learned something the expensive way. Knowing what ICC stands for is not the same as knowing what the market has actually proven. Because gold will give you movement. Gold will give you excitement. Gold will make an incomplete setup look like the opportunity of a lifetime. And if you don't understand the difference between a sequence you can label and a sequence you can trust, you'll keep taking trades that look correct on a screenshot, but make no sense in real time. So today, I'm going to walk you through the 3 things I wish someone had taught me when I first started trading gold using ICC. Because these 3 lessons would have saved me money, frustration, and a whole lot of unnecessary confidence. Let's get into it. Here's the first lesson. A big candle is not automatically an indication. This was probably my biggest mistake. I would open the chart, see gold explode upward, and immediately think, there it is. That's the indication. Big green candle, strong movement, lots of momentum. Surely buyers were taking control. But here's the question I wasn't asking. What did that move actually accomplish? Because gold can move aggressively without changing anything important. Let's say price has been forming lower highs and lower lows. Sellers are in control. Then suddenly you get a large bullish candle. It looks impressive. It moves fast. It gets your attention. But if that candle never breaks a meaningful lower high, what actually changed? Maybe nothing. The market moved. But movement alone is not evidence. That bullish candle could just be a reaction inside an existing bearish structure. It could be a temporary push higher before sellers continue lower. It could be noise dressed up as opportunity. A true indication should do damage. It should challenge the structure supporting the previous direction. It should give you a legitimate reason to believe control may be changing. Not because the candle is big. Not because the move is fast. Because something meaningful actually broke. So now, before I call anything an indication, I ask, what structure was defending the previous move? Did price actually break it? And did that break mean something in the broader context? If I can't answer those questions, I don't have an indication. I have a candle that impressed me. And those are not the same thing. The next lesson, lesson 2, is the correction is not an invitation to guess. Once I started understanding indications, I made the next mistake. I would see price break structure, watch it pull back, and think, perfect, that's the correction. Time to enter. But that's not what a correction is for. The correction exists to challenge the claim made by the indication. Think about it this way. The indication says, buyers might be taking control. Then the correction asks, really? Prove it. Does price pull back in a controlled way? Does the new structure hold? Do sellers regain the ground that buyers supposedly claimed? Does the correction respect the shift, or does price collapse right back through it? That difference matters, because if the indication breaks structure, but the correction immediately destroys the entire move, the market is telling you something. The original claim may not be holding up, but when I started, I wasn't paying attention to that. I just wanted the pullback to reach whatever area I had marked. Then I would enter, because the chart appeared to have 2 out of the 3 letters. I had an I had a C, and apparently, I thought the final C would arrive out of respect for my analysis. That is not how gold works. Gold does not care how badly you want a clean entry. Gold does not care that your stop loss is conveniently placed. And it definitely does not care that you already told yourself this is probably the move. The correction is not your permission slip. It is the market testing whether the indication deserves to be believed. You are not supposed to predict the outcome of the test. You are supposed to watch how price responds. If the correction holds, you may have a developing setup. If the correction fails, you may have invalidation. But until price shows what happens next, you still don't have the complete story. Lesson number 3 is continuation is what separates a setup from a story. This is the lesson that changed everything for me. Because early on, I thought continuation was just the final part of the pattern, something you pointed out afterward. Here was the indication. Here was the correction. And look, there's the continuation. But continuation is much more important than that. Continuation is the market confirming that the original claim survived the challenge. The indication says buyers might be taking control. The correction tests whether that claim can hold. Continuation says, yes, buyers are still here. Without continuation, you're assuming the ending. You're deciding the market will continue before the market has shown you that it can. And gold is very good at punishing that assumption. You'll see a break of structure. You'll see a pullback. Everything looks perfect. Then you enter early because you don't want to miss the move. And suddenly the correction keeps going. Your stop gets hit. Or worse, you move your stop because you're convinced the setup is still valid. Now you're not trading evidence. You're defending a prediction. That's why I say continuation is the lie detector. It exposes whether the indication actually meant something. It tells you whether the correction was healthy or whether the entire idea was falling apart. And sometimes, yes, waiting for continuation means you won't catch the absolute lowest entry. Good. Your job is not to buy the exact bottom. Your job is to participate when the evidence supports participation. A slightly later entry with proof is better than a perfect-looking entry built on hope, because the first person to believe is not automatically the person most likely to succeed. The stronger trader is the one willing to wait until the market has earned the trade. Okay, so now let's put the 3 lessons together. Here's the framework I wish someone had handed me on day 1. First, don't call movement an indication until you know what meaningful structure actually broke. Second, don't treat the correction like an entry signal. Treat it like a test. Third, don't participate until continuation confirms that the original idea survived. That's ICC. Not 3 labels slapped onto random candles. Not a pattern you force onto every move gold makes. A sequence of evidence. The indication makes the claim. The correction challenges it. Continuation delivers the verdict. And until that verdict arrives, you are not obligated to participate. Because the market does not earn your trust by moving. It earns your trust by proving something. If you're learning to trade gold, start asking better questions. What actually broke? What did the correction reveal? And what confirmed that the move deserved participation? Those questions will teach you more than memorizing 1,000 chart patterns. If this helped, subscribe to the channel for more gold trading breakdowns, ICC lessons, and practical market structure education. And if you want to study this framework with other traders who are learning to trade with proof not predictions, join ICCLAB. Remember, a big candle is not proof. A pullback is not permission. And an incomplete sequence is not a trade. No proof, no trade. Never forget, if it's not ICC, it's not a trade.